Hey, everybody, it might seem too early to start thinking about 2025, but it's really not. We're only a few months away from it. We're going to be looking for some bargains that we think could be well positioned to thrive in 2025 and beyond. Tyler Crowe is joining me. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get a message from our sponsor, The Motley Fool, and it's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel, where you can get the top 10 stocks to buy right now. So, Tyler, we're looking for bargain stocks here. I know that's kind of your area. If anyone's a bigger value investor at the Motley Fool than I am, it's probably you. So why don't we start with yours? What do you think is a good stock to look at as we head into 2025?
I, I have a company that I keep looking at, and it's so cheap. I feel like there's something wrong with it. And I'm still looking for why something's wrong, but I haven't quite found it yet. And the company I've been looking at that's incredibly cheap is Canadian Solar. Canadian Solar is a manufacturer of solar panels, but also they do development of solar projects, which makes them a little bit unique in the solar space as of late. Most of the companies that make panels these days have kind of ditched their development arms because it's a very capital intense business. You have to hold these big projects on your books for a long time until you can actually sell it. Makes your earnings very lumpy, and so people don't investors don't like it. They want consistency, right? You don't want to see like a 1 year spike in your earnings of 400% because you had a big sale. Well, Canadian Solar just happens to be one of those companies that still does this development part, and I think in large part because of that, it sells at a relative discount to solar panels or manufacturers in general. I kind of compare it to First Solar, which is, I guess you could say, the industry standard for solar panels. The business itself it's still quite robustly profitable. It's not quite as profitable in terms of margins for compared to compared to First Solar, but it's still respectable in its own right. For the past 5 years, they've had a gross margin of about 18%, which compared to First Solar is typically in the 20 to 25%. So it's not, so far gone that it is kind of a bad player in this industry. They seem to be modestly profitable, 4% net margin on its solar manufacturing. But then again, like you said, there's this very large development arm, which makes things a little bit wonky. And I think that's a part of the reason why, as of late, there has been quite a bit of, I guess you could say, why the market is done its kind of priced it so cheaply is because it's taken on some debt to pay for the development of these, and it's just been sitting on the books until they've been sold. But what's happened lately, and I think this is what makes it particularly interesting, is it just recently signed a deal with BlackRock, where what BlackRock is going to do is, rather than Canadian Solar just kind of sit on these assets until it can completely sell them, what they're going to do is they're going to develop a kind of a joint venture where BlackRock's going to invest in a little bit at these for these businesses, so it can actually monetize it while it's actually being developed, because BlackRock will make some prepayments on it. I think they're going to do about a $500 million prepayment for kind of what's on the books right now, and then they're going to BlackRock is going to kind of develop an operating portfolio of of these utility scale solar and battery storage systems, which you can sell renewable energy on a power purchase agreement to businesses that are trying to meet their net zero goals. So it's a little bit more of a way for them to monetize what's on the books already, without it kind of being this giant bulk and we have to wait until an actual sale happens. So it's going to make it a little bit more efficient, a little bit more capital light, and kind of take away a little bit of the lumpiness of it, which I like. And I think that part of the reason it's been so cheap lately is because of this weird development aspect to it. And when I talk about cheap, on a price to book basis, this company is trading for 0.3 times, which means for every dollar of book value that you have in this business, you're paying 30 cents. I cannot, to me, quite that is a business that seems so cheap that it seems like something's wrong. Like when you hear 0.3 times book, this is selling for less than liquidation value. It's saying like the book value for these things is way overvalued. But I cannot quite find the reason why to think that that is that vastly overvalued. And so as I'm looking at it, I really, you know, unless I find something egregious, and maybe we'll do a video in like 3 weeks where I'll be like, I was wrong. But right now, based on where it's priced and kind of the things that have been happening with this business, I like where it is. And I think it's a pretty good price for this business.
So I like that one. I got burned by First Solar back in the day. I bought it at the 2008 peak. And, you know, that was a
That
tough
was
time to be.
16 years ago, man. That's a whole different business since then. We got to have to do an
I
update
know
on
it.
that.
I know it. But there are a lot of investors who are justifiably scared of the solar business. There are companies in the industry that have not just First Solar 16 years ago. There are companies recently that have not performed very well, and so
Yeah,
it's
I'll admit that solar is one of those weird industries where it's a cyclical industry disguised as a growth industry.
yeah.
So everyone thinks that they're going into it thinking that it's like, oh, it's growth, everything goes up. But this is a very cyclical industry that goes on kind of as supply comes online, pricing goes up and down quite violently.
Yeah. So thanks for bringing that one to my radar. You know, there's been a few solar stocks in the past year or two that have kind of turned me off to it, but I'll have to take a closer look at Canadian Solar. That's one I'm not that familiar with. My stock is not a stock at all. It's an ETF. I've been doing a lot more indexing this year just because I've been so focused on buying individual stocks for, say, the past 10 years. I want kind of more of a backbone in my portfolio that, just is like a bet on the market. But not just like S&P 500 ETFs. There are some ways to hunt bargains without buying individual stocks, and that's important for investors to know as well. And I know Tyler's all about a bargain. One thing I think is a bargain right now in general, and I think you agree with me, are small cap stocks. Not, I mean, obviously we're talking about thousands of companies. They're not all bargains, but just as in general,
it is the Russell 2000. That
right? It is the Russell 2000
stocks.
Um, but there are a lot of reasons to like the Russell 2000 as an index fund play, as opposed to the S&P 500. I like the Vanguard Russell 2000 ETF. The ticker symbol is VTWO. Tyler, by the way, what's the ticker symbol for Canadian Solar?
Oh yeah, CSIQ. I always forget to do that.
Save you a few comments on the video. So there are a lot of we've mentioned in another video, interest rates are set to fall. The biggest projections definitely indicate that interest rates are going to fall over the next few years. There are some big catalysts for small caps in falling interest rate environments. One, small caps are more likely to pay dividends than their large cap counterparts. They're more likely to be dependent on debt. They're generally higher leveraged, so lower borrowing costs come with lower interest rates. They generally benefit when there are more inflows to the market. When money comes off the sidelines, they're generally considered more speculative. And small caps in general are growing at a faster rate. They're by definition, they're small companies that have a lot of room to grow. So listen to some of these statistics. The average company in the Russell 2000 trades for a price to earnings multiple of about 16.8 right now. A price to book multiple on average of 2.0, so 2 to 1, or I'm sorry, two times book, and has a 14% earnings growth rate. The average stock in the S&P 500 trades for a price to earnings multiple of 27 right now, has a price to book multiple of 4.7, and has an earnings growth rate of about 17. So a little higher earnings growth, but not to justify that valuation. On a price to earnings growth multiple, it dramatically favors the Russell 2000. And not only that, the Russell 2000, Tyler just mentioned, it's 2,000 stocks. It's a weighted index just like the S&P 500, but because these are all small companies, it's not heavily weighted. It's not a top heavy index. The three largest companies, I don't even know if you've heard of these, Tyler. The three largest companies in the Russell 2000 right now are Insmed, FTAJ Aviation, and Sprouts Farmers Market. If you just said who, that's kind of the point. These are companies
I've heard of Sprouts.
Yeah, I've heard of Sprouts too, but that's only one of the three. And those are the three largest components in the index. the top five components make up less than 2% of the Russell 2000. The top five components of the S&P 500 make up 26% of the index. You're not dependent on the performance of any one stock. A rising tide for small caps will lift all ships in this case, whereas with the S&P 500, the other 495 components could be doing quite well. But if Nvidia, Apple, Microsoft are all having a bad month, you're not going to perform well. So, much more diversification, much better value right now. And like I said, as interest rates are set to fall, there's a lot of catalysts that can help small caps kind of narrow the gap, narrow that valuation gap. So that's one that I like right now in this environment. I've been putting quite a bit of money into index funds like this one. So yeah, that's what I'm looking at right now. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.